Hey everybody, welcome back to the channel. Today we're going to take a deep dive into a specific type of an annuity. That's right. We don't talk about annuities a lot on this channel, but we're going to look at the multi-year guaranteed annuity, MYGA. As you'll see, it's very similar, at least on the surface, to a certificate of deposit, but there are some big differences that you need to know. Now, we're going to take a deep dive. A couple of things to keep in mind. One is I've never purchased a MYGA. I've done a lot of research on it. I want to share that with you, but I do not have personal experience buying any kind of annuity for that matter, but a MYGA in particular. That's the first thing. The second thing is I'm going to show you a lot of information and I'll link to everything below this video, but I want to just stress that I have no connection whatsoever with any of the annuity products, the websites that I'm showing you. I found them useful in my own research, but I have no financial connection to anything I'm showing you, and you shouldn't take away that I'm somehow endorsing or it's got the Rob Berger, seal of approval. It doesn't. Nothing does. This is just information that I've found useful and that I want to share with you. So here's what we're going to do. We're going to first compare just the interest rates on MYGAs to CDs, because that seems to be the big headline that folks focus on. Then we're going to go into a better understanding of how MYGAs work. That's really important. And part of that's going to be how risky are they? Can the insurance companies go belly up? That'll be the third sort of final thing we'll look at in today's video. So let's dive in and start with interest rates. The first website I'm showing you is called Blueprint Income. Again, I don't know anyone behind this website, never spoken to them, don't know if it's good or bad, but the information they provide is very useful. And you can see they have right up top here, fixed annuities. And there, you can see the rates. We can actually dive in and we can get specific information. The thing I like about this site is I can get information on an annuity without giving them my phone number and my email and all that stuff. So you got to put the amount. We'll just assume we're going to invest, I don't know, we'll make it $100,000. And you got to put your state. We'll just pick Alabama since it's at the top. Show me today's rates. And we see rates. Now we see a lot of other things like rating. We'll talk about that. But we see the rate here and the term. So we'll just use this first one as a perfect example. It's a 5-year term. And look at that, 6.25%. That's better than a CD, right? Well, yeah, a lot better as it turns out. We'll come over here just as an example and we'll look at brokered CDs. This is from Fidelity. You can see the CDs here. If we go to 5-year, the highest they have is 4.6, and some of those could be what's called callable, where the banks can call the CD before the 5 years is up. I don't know if that's the case here. We'll just assume 4.6. There you go. That's the highest, at least as of today. And if we go back to Blueprint Income in Alabama, $100,000, 5-year term, we get 6.25%. And that really is, right there in a nutshell, the big attraction with MYGAs. They can pay a significantly higher interest rate than certificates of deposit. And by the way, even if we want to, you'll notice this is rated B+. That's important to understand. We'll talk about that. And certainly as the ratings improve, and you think it's kind of like A's and B's, right? So an A or A+ rating would be higher, and we could even, we'll find them. I'll show you some of those in a minute. But that certainly, as we look at insurance companies with higher grades, the rates will come down. So keep that in mind. We'll talk about it. So 6.25% looks good, right? Are we done? No, we're not even close to done. Well, we need to understand how these work. And so we're just going to click on the details here. And this provides a lot of very important information. For example, when can we get our money out without penalty, right? We understand that with a certificate of deposit, depending on the term, like a 5-year, we might pay, I would say typical is 6 months worth of interest if we cash out the CD early. But again, that can vary. You'd want to make sure you understand the terms. Well, is that how it works with MYGAs? 6 months of interest and I can get my money out? No. Not even close. So the first thing we can see here for this particular MYGA, remember, this is a contractual arrangement. So it's going to vary from insurance company to insurance company, from product to product. It can vary from state to state. You can see here, during the term of this contract, remember, this is a 5-year MYGA we're looking at, you can be accessed by electing a 10% free withdrawal rider at a 15 basis point per year cost. In other words, you'd get a slightly lower interest rate if you wanted to take out up to 10% per year. From what I can tell, that kind of arrangement is not uncommon. Some of them will allow you to take the interest out without lowering the interest rate, but but you have to keep that in mind. And if you said, well, what if I wanted to just cash this thing out early? Well, let's scroll down here. This is really one of the biggest differences between a MYGA and a CD. If you want your money out early, you're going to pay a truckload in fees. If you want it out the first year, you're going to lose 9%. In the second year, 8%, and you can see the numbers. Charges on withdrawals for a MYGA are huge. And so if you're going to get a MYGA, you really want to make sure as best as possible that you ain't going to take this money out early. Now, you can do a ladder like you could with a bond or a CD. So you could create a ladder of MYGAs so that you had one, say, maturing every year, and that's certainly possible. But there's another issue here when it comes to MYGAs that you have to be aware of. When you've effectively locked your money in, short of paying an enormous fee to get it out early, one of the big risks is interest rate risk. So again, if we go back here and we look at this product, we say, wow, 6.25%, I mean, it's only 5 years and I'll be fine. I mean, yeah, interest rates might go up a bit, but still, that's so good compared to today's rates, I should be fine, right? Well, maybe, maybe not. I was doing some research, and let me show you this. We will look, here we go. So this is a different website. This is Stan the Annuity Man website, and we're looking at 5-year MYGAs as of today. His highest rate is 5.8 right here, top row. I know it's kind of small, and apologies if it's hard to read. And it goes on down from there. That's for a B++ rated company. And okay, so that's for a 5-year MYGA. What would the rate have been approximately 2.5 years ago on this same on a 5-year MYGA? Well, I actually went back. I used the Wayback Machine, where you can see the same website from in the past. And here, this would have been captured you can see it up here, January 14th of 2022. So a little over 2.5 years ago. MYGA fixed rate annuity. Here's the 5-year. 3.15%. So if you had bought that annuity, or an annuity that paid that rate 2.5 years ago, you would obviously be earning significantly less than today's rates. You would no doubt be subject to pretty harsh surrender charges if you thought, well, I want to get out of that so that I can enjoy, I don't know, a 6.25% rate that's available today. You see the problem. For people that bought MYGAs 2 years ago and locked in for some period of time, they're probably kicking themselves. Now, what if they'd locked in? We go back, we look at 10 years. Imagine you locked in a 10-year at 3.25%, right? Now, again, it raises the question, okay, well, Rob, what are interest rates going to do? I have no earthly idea. I know that interest rates, many think they're going to come down. The Fed's going to lower the rate. They could, but imagine if you're buying a product today that's, say, for 5 years or 10 years, particularly that has onerous surrender charges, you're really, as a practical matter, locking that money in, and it may turn out just fine. And maybe rates go down and they stay down, and you're thrilled that you got a 5-year MYGA at 6.25%, for example. On the other hand, rates could come down now, but in a year go back up. And who knows what they'll be a year from now, let alone 5 or 10 years from now. So the interest rate risk on MYGAs is a very real thing, and you just have to bear that in mind. I don't have any secret magic bullet that I can say, okay, well, just do this and you'll be okay. When you buy a longer term MYGA, you are taking the risk that interest rates will go up. And by the way, that also can often mean inflation has gone up, so that the interest rates you're earning on the MYGA, frankly, would turn out to be very disappointing. Now, what some folks will say is, yeah, Rob, I got it. I'm just going to stick with 2- and 3-year MYGAs. Fair enough. There's still some interest rate risk, but obviously it's not as significant as, say, a 10-year MYGA. So but the big takeaway is interest rate risk is real. Okay. Now, the other big difference between a CD and a MYGA are taxes. Annuities are, you should think of them as retirement products. Now, you can buy a MYGA inside either a traditional IRA or a Roth. I personally would never even consider it inside a Roth. I would much prefer to have stock investments that have higher expected returns in a Roth. But you can buy them in a traditional IRA, but you can also buy them in a taxable account, right? And you can see over here a lot of information. And again, I like this website a lot for the information it provides. And it includes information on taxes, right? If you buy this in a taxable account, a couple of things to keep in mind. The first is, if you take the money out, it's right here, maturity options, it's right here. If the contract matures before you turn 59 and a half, withdrawals, other than rollovers to an IRA, will be charged a 10% penalty by the IRS. So if you're not at least 59 and a half, if any money that you pull out because of maturity or money you take out early, interest, for example, could be subject to an IRS 10% penalty. That's the first thing to keep in mind. The second thing is that with a MYGA, if you don't take the money out, it's not taxed yet. So there's tax deferral built into a MYGA. Unlike a CD, you accruing and earning interest every year, it gets taxed every year. But with a MYGA, if you're not taking it out, you're not paying tax until you do. And here's the thing, when the MYGA matures, you can roll it over into a new one or even a different type of annuity. So there is some tax deferral built into MYGAs that can, I think for me, that's a positive. How much it really matters at the end of the day and how much it's going to really impact your bottom line, well, you just need to think that through and figure that out. It's going to depend on your tax situation and a lot of other factors. But the real big point here is that taxes on MYGAs are different. In some ways, I think, they're favorable, perhaps, like tax deferral. In other ways, like that 10% penalty if you're not 59 and a half, obviously not a good thing. So that's the taxes. Now, the next thing we want to jump into, and this is another big difference, is how secure are they? You get a CD at a bank and it's FDIC insured. We know what that means. With a MYGA, you're buying it from an insurance company. And how strong is that insurance company, and what happens if it goes belly up? Well, let's take a look. You'll notice here with these MYGAs that they give you what's called an AM Best rating. AM Best, that is a company that rates, in this case, annuity companies. They provide a rating, and they actually have a guide. We can look at it right here, and I'll link to all of this. And we can come back here. This is B+, right? So we can come here, and B+ is right here, this bottom line. So this is in what they call secure. I don't know if you can see that there. So let me make this a little bigger. They sort of divide their ratings between B+ and higher, which they call secure, and then I'll call it B and lower, and they call that vulnerable. And so B+ is sort of the bottom rung of what they would call secure. And the question becomes, well, secure, certainly better than vulnerable. But as a practical matter, what does that mean? Well, AM Best actually puts out data on all of this, but it costs a lot of money to get at it. And I've not been able to find a good source for it. I will tell you that I found this. This is as of 2018. This is their financial, this is the AM Best Average Cumulative Gross Impairment Rates, FSR, which is financial strength rating. And it gives you sort of the odds of a company having trouble based on their rating and in the years. And you can see that the risks go up over longer periods of time. The B+, which is right here, is certainly not without risk. Now, again, this is dated information, and I will leave a link to this. I could not find current information. Maybe someone can, and if you do, please let me know. But the point is, there are definite risks that an annuity company, an insurance company, could go under. Now, of course, that raises, I think, at least two questions. One is, what happens if they do go under? And then the second thing is, well, which rating should I aim for? How should I think about that? So first of all, state insurance, there's state laws and regulation of insurance companies, and they have protection in case an annuity company goes under. That protection varies from state to state. For a lot of states, it's $250,000, just like FDIC insurance. There's some states it's a bit higher. Some states it's lower. So you need to do your due diligence to look at what your state offers and how exactly it works. But there is potential coverage. Now, you also want to look at, as a matter of just practicality, what happens if the insurance company does go under? How quickly can I get my money back? I will tell you from my research, it depends on exactly what kind of annuity contract you have. But I think that's something that you're going to have to research, right? That's the first thing. Now, the second thing is, well, does it matter? Like, how much do interest rates change based on the rating of the insurance company? Well, we can actually look at that. If we go back to Blueprint Income, remember we saw this 6.25, it's a B+ rated company. we can actually sort this by financial rating. So let's say we just want the top, A++. So remember, we had 625 with any rating, happened to be B+. What's our best rate for an A++? It drops to 5. That's a huge difference. That's 125 basis point difference. So, and if we said, well, how about A+ or better? Yeah, we get another 25 basis points, right? So there's absolutely a correlation between the rating of the insurance company and the rate you get. Now, the reality is, I don't think there's an easy answer on, well, what rating should you require? But I can give you a couple of things. Some might say, wait a minute, Rob, if I've got the state to back me up, what do I care? It's like a bank. I mean, if the bank's a member FDIC, what do I care how strong the bank is? I mean, yeah, there could be some hassle, going through whatever process I need to should they go under and getting my money through the FDIC. But as long as I'm not desperate to have it immediately, I'll get my money back. And so same thing maybe with your state's regulation of insurance companies. I suppose if you don't find yourself in a hurry to need the money, it's going to eventually come, presumably, then you could take that approach. What I've seen as well is a lot of folks say, well, it depends on the term of the MYGA. If you're going to go for 10 years out, you really kind of want a higher rating because that's a long time to lock up your money with a company, and you want to make sure they're on solid footing. So, you may be wanting A+, something like that. If it's a 2-year, a 3-year, maybe you're willing to take more of the risk and go into the B+ kind of ranges to get a higher rate. Again, I'm not making any recommendations here. I'm just giving you a couple of different ways to think about it. Now, I want to show you a couple of other resources before we bring this video to a close. The first is this article on Kiplinger, I think it was 2022, 2022, Why Fixed Rate Annuities Pay More Than Bank CDs. I think this is a good resource, walks through a number of things as to why you can get a higher rate on a MYGA over a CD. I'll let you check that out. This one was actually from 2015, but I thought it was important. What happens when your insurer of your annuity goes broke? One of the things that I noticed in this article, they cited some data from the National Organization of Life and Health Insurance Guarantee Associations. And what this representative said, the president of that organization, this was back in 2015, said, hey, since 2008, so this would have been over a 7-year period, only 6 insurers licensed to sell annuities have entered receivership. Okay, that's an interesting data point. And I actually looked this organization up for you guys, and guess what? They actually have a list. Now, not all of these companies sell or sold annuities. In fact, I noticed this first one, I think it sold burial policies, pre-need funeral policies. But many of them did sell annuities, including North Carolina Mutual Life, which ran into trouble in 2022, and it sold, among other things, I don't know how well you can read that, annuity products. So I will leave a link to this resource for you as well below the video. So at the end of the day, I think MYGAs are worth considering as a CD alternative. I can tell you for me, I'm probably not interested. I just don't want the added complexity. But if I were, I would certainly err on the side of shorter term MYGAs for me, if I were going to consider them, and probably from companies that were higher rated, probably in the A's somewhere, just because I wouldn't want to have to deal with the risk of the hassle of dealing with state regulators and getting my money back. At the same time, they do have notably higher interest rates than comparable certificates of deposit. And the fees there are fees, but they're already baked in. When they say you're going to get 5%, that's what you're going to get. By the way, another thing I like about Blueprint Income, and again, this is not at all a recommendation for Blueprint, but when you look at the details of a particular MYGA, among other things, they actually disclose their commission rate right down here and give you some information about it. Again, that's already baked into the rate that you're going to receive in this case for this particular MYGA, 5.25%. I'll close with this one observation. If you're ever talking to an annuity salesperson, like if you've ever gotten that card in the mail where you're going to go to some steakhouse for free dinner, they're probably not going to promote MYGAs. They're probably going to try to get you to buy indexed annuities. Why? Because the fees, There might be different reasons. There could be some legitimate reasons, although it's hard for me to actually think of one. But I can tell you the fees that a salesperson will earn on an index annuity are much, much higher than what they're going to earn on a MYGA, at least based on my research. So keep that in mind. Having said that, I would never ask an annuity salesperson, should I buy an indexed annuity, a MYGA, or any other kind of annuity? It's kind of like asking the barber if you need a haircut. All right, there you go. If you have any questions, please leave them below this video. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.